Men of multipliers, what's hanging? Good to be with you guys today with Leo Pareja. Some of you guys recognize this name if you are on the brokerage side, but let me hit a couple points on Leo so that you guys know why he's coming in for raising capital. He runs Remind, which raised $48 million and has 80% capital share for real estate brokers and agents around the world. And then Washington Capital, which deploys about $400 million a year out on the street in the mid-Atlantic. So, Leo, you're a guy that's raised money, obviously, and those are your credentials to talk about that. You and I were chatting, and one of the first points you made, and you said, man, this is like foundational, but it took me a while to understand the importance of this, and that is you got to go to people who like the asset that you're raising capital for. Talk to us about that and why that's been an important principle for you.
Yeah, no, and like you said, it took me a while to get there, and it seems so fundamental when I say it out loud now, but it's the first mistake I see when people are raising money. So if you were to raise money for a real estate deal, there's equity and there's debt, right? Debt people don't like equity. And most people who are willing to do debt don't like the returns that debt pays, or equity that the debt pays. So it's going to folks who have an appetite for what it is you're raising that's become a game changer for me over time. So people who like first deed of trust and are comfortable with those instruments and what comes with it and the risk that comes with it, are a different profile of people who like equity, where it's a real estate deal versus an operating business. So, you know, in our latest venture, raising money for software is a completely different strategy, and the expectations are, you know, 5, 6, 10x return on money, with the downside being zero, versus the people that put money in a real estate deal pretty much expect no downside and a fixed return. So I always encourage people to go after folks who have an appetite and experience, because they make much better investors who won't be showing up at your project every day, right? If you get money from a non-real estate person, they may want to opine on the colors that you're picking, the tile that you're selecting, and that's not what you want.
And I think it's really a great principle, right? If somebody is hungry for what it is you're raising capital for, it's going to be the better match long term. But we might not think about that. We just want to go after people as a whole because they have money to invest, rather than going that one layer deeper and making sure not only do you want to invest, but I got to make sure you want to invest and you have experience and an appetite for what it is I'm raising capital for. Because it sounds like, from what I hear from you, that saved over time a lot of pain and heartache that could have been avoided.
Absolutely.
Awesome. Men of multipliers, soak it up. Leo, thanks so much. It was great hanging out with you, buddy. Stay tuned for number 2.